I know the House people aren't used to the electronic gavel. So, but good morning, everybody, and welcome to the JLARC July meeting. And we're so pleased to have you here. We have 4 members who will be joining us virtually, and those are Delegates Simon, Ware, and Wilt, and Senator McPike. So thank you all for joining us virtually. And today's meeting will deal with several reports and ongoing efforts by JLARC to examine VRS and the retirement savings plan. So with that, I will turn it over to Hal to get us going.
Thank you, Madam Chair. Good morning, Madam Chair, Madam Vice Chair, and members of the Commission. I'm Hal Greer, the Staff Director of JLARC. The July meeting is traditionally the meeting at which staff update the Commission on the Virginia retirement system and Commonwealth Savers as part of JLARC's responsibility to conduct ongoing oversight of both. This meeting also provides the opportunity for the Commission to hear directly from the leadership of those two organizations. Madam Chair, I'd like to now introduce Kimberly Sartay. Kimberly is the Associate Director at JLARC who oversees all of JLARC's ongoing oversight. Kimberly?
Thank you, Hal, and good morning, Madam Chair. As Hal mentioned, today's meeting is dedicated to JLARC's oversight of VRS and Commonwealth Savers. JLARC is required by the Code of Virginia to oversee both of these agencies on an ongoing basis. The first half of today's meeting is dedicated to VRS. So first you will hear a brief update from JLARC staff, basically myself, and then you will hear from JLARC's actuary on the results of their quadrennial actuarial audit of VRS. And finally, you will hear from VRS directly as they give you their annual update. After that, we will shift gears to Commonwealth Savers. And again, you will hear an update from JLARC staff on Commonwealth Savers, and then you will hear directly from Commonwealth Savers staff. So, Madam Chair, I will now turn to our semi-annual report on VRS. So for some of our newer members, we present to you on VRS twice each year, once in July and once in December. This slide shows you the mandate for our continuing oversight of VRS, which is in the Code of Virginia. The code requires us to report on VRS investments and other issues such as the structure, governance, and management of the system. We are also required to conduct an actuarial audit of the system every 4 years, which you will hear about today. And we are required to publish a legislator guide for VRS as well as Commonwealth Savers. And we recently issued our latest guides, and you should have found them in your mailboxes recently. My presentation today has 3 parts, and I'll start by discussing the VRS trust fund investments. As you probably know, the financial assets used to pay VRS benefits are pooled in its trust fund. These include the assets for the various retirement plans, as well as the other benefit programs like the Retiree Health Insurance Credit. A core responsibility of VRS is managing the investment of those assets. As of March 31st, the VRS trust fund held approximately $129 billion in assets. And as you can see here, the trust fund outperformed the long-term return assumption the board has set for the trust fund of 6.75% for all periods. And this is important because if the fund did not exceed that 6.75% return over the long term, funds would need to be made up through higher employer contribution rates. There was a question at the May meeting for how VRS returns compare to other large public pension plans. So that's what this slide shows. This data was provided by Milliman, and it's a little bit dated. It's as of 2024, because it takes them a while to pull all this information together. But what this shows is that VRS, with a 10-year return of 7.6%, achieved higher returns and kept volatility lower compared to many other plans. And you can see this because they are in the top left quadrant, which is where plans want to be. When you look across funds, returns are obviously important, but volatility is as well because it is difficult to manage a plan where returns are varying significantly from year to year. So far, we have been talking about absolute returns, but returns compared to the fund's investment benchmarks are also important because it shows how efficiently the funds are being managed. What you see here is that as of March 31st, the total fund at the bottom outperformed the benchmark for the 5- and 10-year periods, but underperformed for the 1- and 3-year periods. Because VRS is a long-term investor, the longer terms are more important, but it's still important to keep an eye on near-term performance. They had some underperformance in the near term across asset classes, but the one that is driving the total fund underperformance is private equity. And that's because it's their second largest asset class, and it underperformed by quite a lot in the near term. And you can see the actual performance on slide 17 of your slide deck. It's not uncommon to see private equity lag its benchmarks in strong public equity markets, which is a posture we have seen in recent years. And talking about benchmarks leads me to the next slide, which is at the June meeting, the board adopted new benchmarks for several asset classes. These include private equity, credit strategies, and diversifying strategies. The board determined, with the assistance of VRS investment staff, that these new benchmarks are a better fit for these asset classes and will allow for a more accurate assessment of their performance. The most significant change I'd like to highlight is for private equity, where VRS switched from a public equity-based benchmark, which is commonly used by funds, to a private equity fund universe benchmark. VRS staff determined that the new benchmark is a better fit against which to judge the private equity performance. Now, benchmarks are important because they are how stakeholders, like the board and the General Assembly, can assess VRS's investment performance. But they're also important because they affect the incentive pay earned by VRS investment staff. And based on the advice of a consultant, the board adopted changes to incentive pay to reflect the new benchmarks. The consultant determined that the new private equity benchmark is expected to be more difficult to outperform over the long term, so significantly less overperformance will be required in the future for investment staff to receive incentive pay. This change will also reduce the required outperformance for the total fund because it is a composite of the various asset classes, including private equity. JLARC staff have requested that VRS track both the new incentive pay approach and the previous approach for the foreseeable future to ensure that the changes themselves are not leading to consistently higher pay for investment staff. And Madam Chair, I can pause here if there are any questions. Next, I'll turn to the defined contribution, or DC plans. DC plans are similar to a 401k or IRA. There are several types of DC accounts available to members, some for primary income and some for supplemental income. Overall, the DC plans hold about $12 billion in assets. As you can see here, nearly all investment options offered across three categories of DC plans met or exceeded their benchmarks across all periods. At most, only one option missed its benchmark for any period. And the final section of my presentation is about key recent legislation. And there's not much to report because not much legislation was passed this session that affects VRS. However, most importantly, the General Assembly fully funded the board-approved employer contribution rates for the 2026-2028 biennium. And the General Assembly also made a $94 million deposit to the Retiree Health Insurance Credit Program to help pay down unfunded liabilities. Madam Chair, that concludes my presentation, and I'm happy to answer any questions if there are any.
Are there any questions at this time?
All right. Next, Madam Chair, you will receive the findings of an actuarial audit of VRS. JLARC is statutorily required to conduct an actuarial audit of VRS every 4 years, and we do this with the help of an actuarial consultant. It is a best practice to conduct periodic independent audits of retirement plans to assess the actuarial assumptions, the cost methods, and the accuracy of the calculations that go into the plan valuation results. And this is because it's the plan valuations that determine the funded status of the plans and the employer contribution rates. So I would now like to introduce Ryan Falls and Scott Porter from Milliman, which is a consulting firm that conducted the audit. And then following their presentation, Trish Bishop, VRS's director, will provide a brief response. And after that, Trish will introduce the VRS board chair, who will kick off the VRS annual status report portion of today's meeting. Ryan and Scott.
Great. Madam Chair, members of the Commission, thank you for your time this morning. My name is Ryan Falls. I'm here with my associate, Scott Porter, and we're here from Milliman to report on the quadrennial actuarial audit for VRS. The purpose of an actuarial audit, you do it every 4 years. It's great governance and oversight of the retirement system. We reviewed the 2025, the most recently completed actuarial evaluations and the experience study, the assumptions that went into calculating the results, the funded status, and the ultimate contribution rates for the retirement systems. This included all of the pre-funded plans administered by VRS, the state pension plans. We looked at a subset of the political subdivisions Also group life insurance program, health insurance credit, line of duty, and both the disability plans I review included all of these. And part of this actuarial audit, we look at the inputs, the data that comes in, the assets that are used, the techniques that are used to smooth the asset returns, the assumptions and the methods that go into it, and then we review ultimately the results that come out of it, again, the funded status and the contribution rates. This was called a quote-unquote limited scope actuarial audit, and the reason for that is we looked at a subset of calculations members in the plan and replicated the subset. We didn't replicate the entire plan, the entire liability. We looked at a subset of the members that participate in the retirement system. And probably as far as a headline goes for you all as a commission, the results of our actuarial audit were that based on our requested scope, we did find the results of the actuarial evaluations reasonable. Again, we looked at the data that came in. That was into the process. That was reasonable. The assumptions are reasonable. The liability replication, again, I said it was a sample. We looked at 107 people that participate in VRS and replicated their liability in all the different plans that they participate in across the VRS programs. Found the methodology and the resulting contribution rates to be reasonable. These are large, complicated processes, these actual evaluations, and VRS is a large, complicated system. So as we went through there, we did have a series of recommendations that we thought would enhance future actual evaluations and future studies. But the bottom line is, in total, everything was reasonable, but we do have some recommendations, and my associate Scott's gonna go over those for us.
Yeah, good morning. So as Ryan noted, the purpose of the actuarial audit is to review the various functions, elements, and disclosures of the actuarial evaluation to enhance the funding process. And so over these next couple of slides, we're going to highlight those issues to be of most significance that were found during our review. There are additional items that are included in the report. On this slide, we comment on 3 items related to providing cost of living adjustments or COLAs. So when a member retires and commences their benefit, the benefit will increase in the future due to changes in inflation. And statute dictates when the COLA will occur and how that COLA is determined each year. And the first 2 columns on the slide recommend improvements to the valuation program to reflect when that COLA will occur. So for members who have reached unreduced retirement, the COLA would begin the July 1st, following 1 full calendar year after retirement. So this translates into the COLA beginning as early as 18 months to as late as 29 months following the member's retirement. The valuation program uses 12 months following retirement, so we believe reflecting the delay in the COLA would have a notable impact, resulting in lower plan liabilities and contribution rates. For those who have reached for those who retire with a reduced benefit, the COLA is delayed further until they would have attained unreduced retirement age. But there are relatively very few members who retire with a reduced retirement benefit, and thus we believe this would have a minor impact on the plan liabilities. Now, the third column deals with the development of the assumption itself, how that COLA is determined. Currently, the assumption for future COLAs is set to the assumed rate of inflation of 2.5% for Plan 1 members. For Plan 2 and hybrid members, it's set to 2.25% because these members will only receive 50% of the change in CPI in excess of 2%. Based on these statutory caps and limitations, the maximum COLAs is 3% for the Plan 2 and hybrid members. It's 5% for Plan 1 members. With the 2.5% inflation assumption reflects the fact that inflation may be higher in some years and lower in other years. And so due to these statutory caps and limitations, the average COLA would be less than the average rate inflation. So while we suggest that consideration for this difference be reviewed and incorporated into the next experience study, we do believe that the current COLA assumptions are generally reasonable. Now, on the next slide, we discuss 2 items related to the life expectancy assumption, or the mortality assumption. And it comprises of 2 components. What are the current rates of mortality that apply in, say, 2026? And how will those rates improve in the future? What will the rates be in 2046, 2066? The Society of Actuaries publishes a mortality improvement table with the latest one known as MP 2021. And the valuation actuary uses 75% of this scale, meaning that improvement in mortality rates for VRS members will be less than the published study. Now, to study mortality improvement, you really need a lot of data for the study to be fully credible. So we recommend the actuary specifically note why 75% versus 100% is used, and using 100% of the scale will result in an increase in plan liabilities and contribution rates. Now, the second column really deals with a technical application of the contingent survivor mortality table, one of the various tables that are used in the valuation. This contingent survivor table is based on beneficiaries or survivors' experience after the retiree's death. This group would typically have higher rates of mortality, what you would refer to as the widowhood effect. But while the higher rates of mortality will apply after a retiree's death, they would not be expected to apply while the retiree is alive. So reflecting this point would be expected to have a minor increase in plan liabilities and contribution rates. Now, on the next slide, regarding funding parameters, we discussed two items related to the timing of contributions relative to the timing of the actuarial valuation. In odd years, such as the 2025 valuation, it determines the contribution rates applicable for the fiscal years July 1, 2026 to June 30, 2027, as well as the following fiscal year ending June 30, 2028. So in odd year valuations, we recommend that 12-month lag between the valuation date of July 1, 2025 and the start of contributions occurring July 1, 2026 be reflected. In even years, we recommend that the amortization basis be adjusted to reflect that the first payment will not occur until the next odd year rate-setting valuation. Each year, new bases are established to account for differences in actual experience and that expected. We would anticipate that these recommendations would reduce the amount of these new bases established each year by aligning the contribution dollars with the expected reduction in the unfunded liability with each valuation period. And then finally, on the next slide, notes a couple of disclosure items to enhance the communications of the unfunded liability. The unfunded liability is split into slices, with each new piece determined based on the difference between how the unfunded liability was expected to change versus how it actually changed. And with all of these slices, the amortization periods can vary, and they will also vary for each local employer based on their own experience. And so currently, the valuation reports denotes the variance in those amortization periods, so 4 to 18 years. We recommend that the reports include when the unfunded liability is anticipated to be eliminated based on these varying amortization periods. We believe this will provide the users of the report with more useful information regarding the unfunded liability. And then, as I noted in the previous slide, there are delays when the contribution dollars occur versus the contribution rates are determined in the valuation. This difference contributes to that annual change in the unfunded liability that is determined each year, and we recommend that this difference be noted in the actuarial gain-loss analysis that's included in the valuation report.
All right. One more slide, and then we'll pause for any questions you may have. I mentioned 2 disability plans that VRS administers, and these are somewhat unique. All the other programs we've talked about pay a benefit starting at retirement through the remainder of the retiree's lifetime. The disability plans are a little bit different. These benefits pay when a member becomes disabled during their working lifetime, but actually cease at retirement. So the way they're structured and kind of where the liability sits and the duration of the liability is a little bit different than the retirement program. And so we have a unit within Milliman that specializes in working with these plans and pre-funding these plans. These are pre-funded plans where there's money saved up to pay these benefits. In our actuarial audit report, we discussed a suggestion for ways to look at funding these disability plans a little bit different than it's being done now. The method that's being used right now is a fairly common approach to pre-funding disability plans. We discussed in our report just another way to look at how you pre-fund a disability plan and look at it a little bit more holistically than kind of the accrual accounting and the accrual funding that's done now. It was just a suggestion that in the end, the plan's going to cost what the plan costs, but this method would just kind of change the pattern in which contributions flow into the plan. There's also an incurred but not reported liability that we recommend incorporating into future disability valuations. That's liabilities for those that have there's a little bit of a lag when someone becomes disabled and when benefits commence. And so there's 3 to 6 months worth of potential employees that have become disabled, but their benefits haven't commenced yet. And that's a slice of liability that we think could be incorporated into future valuations and enhance the valuation. But again, in the disability plan, we were within 1% of our liability replication, just like the rest of the plans. So with that, we'll pause, and we're happy to answer any questions the commission has. Madam Chair.
Any
Thank you.
questions with regard to this report? I think they're good.
Thank you.
Okay, thank you.
Good morning, Madam Chair. I'm Trish Bishop. I'm the Director of the Virginia Retirement System. Thanks for the time to briefly respond to the audit report. We greatly appreciate the thorough review and the findings that Milliman provided and the hard work that they put into this very exhaustive review. Their findings provide independent assurance that the work of both VRS and its actuary is performed in accordance with actuarial standards of practice and confirm that VRS's financial health is accurately reported. Most important, the audit validates VRS's ability to meet its future financial obligations in keeping with its fiduciary and statutory duties. VRS generally concurs with the report while noting that some findings and recommendations may benefit from additional context and clarification, and our external actuary, Gabriel Roeder Smith and Company, submitted a letter with detailed comments to clarify some of those items in the report. We certainly welcome opportunities to further enhance our future documentation around the valuation process and greatly appreciate Milliman's suggestions and comprehensive review. In sum, the Milliman report reflects the commitment of VRS and our plan actuary to sound governance, professional standards, and transparent reporting. We again appreciate the thorough review and professionalism of Milliman and the JLARC staff in conducting this important audit, and we continue to work to meet a high standard for accuracy and transparency in service to VRS members and stakeholders. So we appreciate the opportunity. I'll be happy to take any questions regarding the report.
Thank you. Any questions to Ms. Bishop?
If
Okay,
not,
all right.
I will take the opportunity to introduce our new board chair, Dr. Susan Gooden of the VCU Wilder School.
Good morning, Madam Chair Locke, Madam Vice Chair, Delegate Carr, and members of the Commission. I'm Susan Gooden, and it's an honor as the new chair of the VRS Board of Trustees to present our annual update on behalf of my fellow board members. As a quick introduction, I'm a native Virginian with 30 years of service in the Virginia Retirement System, and most recently served as Dean of the L. Douglas Wilder School of Government and Public Affairs at Virginia Commonwealth University. Throughout my career, I have focused on making public service more effective and equitable. Since our last report to the Commission, there's been one addition to our 9-member board. Mr. William Leidy, managing partner with Decide Smart LLC of Richmond, was appointed by Governor Spanberger in March of this year. Mr. Leidy previously served as the VRS board member and also as a past director of VRS. My service on the VRS board began in 2020 at a challenging moment for markets and public institutions alike. In preparing today's remarks, I reflected on VRS's progress in member services and portfolio growth since that time. I am proud to share that we have expanded online access and retirement planning tools, strengthened data security, and broadened educational outreach to effectively support members, retirees, and employers across Virginia. In 2020, the VRS Trust Fund stood at $86.1 billion. Today, the fund has a market value of approximately $134 billion, which speaks to the effectiveness of our diversified investment strategy and diligent risk management. VRS remains committed to building and protecting the fund for public employees who provide essential services to the Commonwealth of Virginia. Good governance is a pillar of the VRS system, and independent oversight is essential to maintaining trust with our stakeholders. Accordingly, we sincerely appreciate the actuarial audit conducted by Milliman that JLARC oversaw and reported out a few minutes ago. In the spirit of good governance, each year, CEM Benchmarking, a leading data and insights firm, measures our investment and administrative operations compared to pension systems of comparable size and provides actionable insights. Their latest report places VRS's investment management in the favorable quadrant, signifying superior performance at less cost than our peers. Over time, the VRS portfolio continues to outperform the 6.75% actuarial assumed rate of return. These results demonstrate the value of our steady, long-standing approach to weather fluctuating market conditions. VRS, like other agencies, just closed out our fiscal year. While we do not have final performance numbers for you today, we can confirm that we have solid performance. Following my remarks, Chief Investment Officer Andrew Youngkin will provide you with an investments overview of the past year. I also would like to highlight the growth VRS is seeing in member savings through its defined contribution plans. As of March 31st, total assets in those plans were about $12 billion, a nearly 20% increase over last year, with nearly 750,000 accounts representing more than 400,000 unique participants, which is up 13% this year. The VRS administrative team, led by Trish Bishop, is continuously educating all members, and especially hybrid retirement plan members, to save more for their future using the numerous tools shown here that we have in place. For example, to start new hybrid plan employees on the path to savings, we are working with the Department of Human Resource Management to update its new hire webpage with links to the VRS Hybrid Learning Channel videos. Following last year's JLARC study of the hybrids plan's defined contribution component, we have partnered with our record keeper, Voya Financial, to launch additional campaigns. Some examples include a campaign targeting those under age 40 to save money for the future, and another one that connects birthday milestones with retirement planning reminders to increase voluntary contributions and maximize the employer match. VRS also supports options to help hybrid plan members save more through voluntary contributions. More frequent auto-escalation and automatic enrollment for new members have proven the most effective ways to get members to save. However, as noted previously and in the prior JLARC report, expanding those automatic features would require legislation. In closing, the VRS Board of Trustees extends its gratitude for your steadfast support. Your commitment to fully funding contributions has allowed the system to pay down unfunded liabilities and improve the overall health of VRS plans. VRS's strategic and diversified approach to investing has elevated the trust fund's market value to approximately $134 billion. Through continued partnership with the Governor, General Assembly, and our local employers, VRS can deliver on the promises made to the Commonwealth of Virginia's public employees. We are especially gratified by the recent infusion of $93 million into the State Health Insurance Credit Fund, which will meaningfully lower liabilities and reinforce the fund's financial footing. Thank you so much for your continued support of VRS and our mission. I'll now ask VRS CIO Andrew Youngkin to share an update on VRS investments.
Thank you, Dr. Gooden.
Good morning, Madam Chair, members of the Commission. I'm Andrew Youngkin, the Chief Investment Officer for the Virginia Retirement System, and my part of the presentation today will just be a quick overview of our long-term investment strategy, an update on our returns, an update on how the VRS team delivers value for the plan, and a quick update on current markets. Every 3 to 4 years, VRS conducts an asset liability management study. This is a critical part of the governance of the plan. This sets our long-term investment strategy by deciding our strategic asset allocation, the mix of different kinds of assets like stocks and bonds. We use this to help us meet or exceed our target returns while minimizing risk. The last study was conducted 3 years ago, so we'll be embarking on a new study this fall. And as you can see from this slide, we manage a very diversified portfolio and are not too reliant on any particular strategy to drive success. I will note that the Code of Virginia requires the board to diversify such investments so as to minimize the risk of large losses, so you will hear throughout this presentation how we are focused on risk management. Slide 16 presents the VRS fiscal year returns. Now, I will note that the 6.75% assumed rate of return is a very long-term assumed rate of return, more than 20 years. We do measure it on a fiscal year basis, but as you'd imagine, and as is presented here, there is some volatility in yearly returns versus a 20-year-long expected return. We've had strong returns in the last several years, and as noted, we expect fiscal year 26 will be another one, expecting well above the 6 3/4 target. Total fund performance through March 31st is presented here. I would just note that the fourth quarter of the fiscal year was another strong quarter. And as noted earlier, you can see some underperformance at the total plan level for 1 and 3 years, again, primarily driven by private equity, which has struggled to keep up with its public equity benchmark. But long-term returns, 5, 10, 15, 20, and 25 years have all outperformed the board-established long-term custom benchmark. All of these returns, 1 through 25 years, are in excess of our 6 3/4 return target. The next 2 pages are a deeper dive into performance as of March 31st. So you can see the asset class level returns, and then again, as of April 30th. I will not, in the interest of time, dig deeply into any of those unless there are any particular questions. And I'll move on to slide 20. Again, as a reminder, this is our March 31 asset allocation. You can see we're very diversified. The total plan value at March 31 was just under 130 billion. It's now almost 135 billion. One of the ways that we manage risk is through measuring and managing liquidity for the plan, and we maintain plenty of cash and liquid investments to pay benefits and other obligations of the plan. You've seen a bunch of peer comparisons. I'm going to give you one more. This is actually risk versus return. So risk runs along the horizontal axis. A plan's returns are more volatile the farther to the right they are. They're less volatile the farther to the left they are. And then return is on the y-axis. So higher would be higher returns, as you'd expect. The intersection of those 4 colors is the median public plan. So anything up and left, as the VRS total fund is, means we've generated higher returns while taking on less volatility. And you can compare that to both the median, but also to the total fund benchmark. We've outperformed the benchmark while doing it with less volatility. This is the 5-year snapshot as of March 31. The next page is the 10-year snapshot. Again, we focus very much on the long-term performance of the plan, but the results are the same. We've generated excellent returns with lower levels of volatility. Here we go. We also manage almost $48 billion of the portfolio internally. We do this because it is a way to generate fee savings while still creating excess returns. So we manage essentially all of the fixed income portfolio in-house, about half of the public equity portfolio, and a significant part of the private market assets in-house. This saves a lot in fees that we would otherwise have to pay to external managers, and it has still generated excellent returns. This slide is also from the CEM slide that was previously referenced. It breaks down our 10-year total value add, both in terms of basis points, but it translates that into dollars. So the excess returns that the plan has had has generated extra almost $6 billion compared to what would have been generated by just matching our benchmark. The two slides at the bottom, or the two graphs at the bottom, the one on the left is about using our buying power to negotiate lower fees with external managers, and that saved an additional $33 million. And then using in-house asset management, which we just discussed, has saved $154 million versus outsourcing that. Moving on to markets, we've had very strong market returns over the past 4 years, driven largely by the stock market. Inflation remains a concern, both for the economy and for markets, and with a new Fed chair, remains to be seen exactly how that will be addressed, but he seems to be very focused on moving inflation back down to the Federal Reserve's target levels. The key principles for VRS of diversification, focus on long-term returns and risk management help guide the portfolio through turbulent times when they do arise. One of the things that we have been focused on for the last several years is strengthening our risk management capabilities and efforts. As I mentioned earlier, we are keenly focused on maintaining a sufficient amount of liquidity so that if the market does dislocate, if returns become negative, if there's some sort of event in the economy or financial markets, we have plenty of liquidity to be able to pay benefits and to meet other obligations. We perform regular stress testing, and the key principle for us really is that we manage a very diversified portfolio. We are continuing to focus on generating fee savings with the use of internal management, and as you can see from this bottom bullet point, we have an experienced and highly qualified staff that is highly credentialed. To sum up, VRS is in a stronger position than a year ago when we made this same presentation. Strong returns in risk management have improved funded status and kept contribution rates steady. I'm happy to take any questions or to turn it over to VRS Director Trish Bishop.
Question from Delegate Rasool.
Thank you, Madam Chair. Thank you for that great presentation. Very useful information. Just a quick question. Beyond maximizing the value to the shareholder, are there any other public policy interests that come up in investment decisions?
Madam Chair, Delegate Rasool, we are focused on pecuniary interests only. That is, our fiduciary obligation lies with the beneficiaries of the plan. So we do not manage to any other public policy aims. We manage to generate the highest level of return for a given level of risk across the total plan.
Thank you, Madam Chair.
Are there any other questions? And if those of you who are listening online have questions, if you could just raise your hand and we will be notified of your interest in asking a question. Thank you. But thank you.
Good morning again. Thanks for the opportunity to provide this year's administrative update. At VRS, our mission is clear: to deliver retirement and other benefits to Virginia's public employees through sound financial stewardship and superior customer service. That mission guides our work every day, and it's strengthened by the ongoing support and partnership we receive from our employers, the General Assembly, and the administration. This slide gives you a snapshot of VRS's total membership. We serve more than 880,000 members, retirees, and beneficiaries across the Commonwealth. Other than hazardous duty employees and effective July 1 judges, most new employees will go into the hybrid retirement plan. That's our largest active plan with about 213,000 members. It represents about 55% of our active members. Last year, we paid out about $7 billion in benefits to VRS's 254,000 retirees and beneficiaries, as about 84% of VRS retirees remain in the Commonwealth. Those benefit payments recycle and help into boost state and local economies. So I'll turn now to plan health, and funded status is a commonly used measure to assess plan health. It's a ratio of assets available to pay benefits. As the chair mentioned, with your partnership, we've made steady progress in improving the funded status of VRS plans. As of June 30th, the state plan of 2025, the state plan was about 85.4% funded on a market value basis. Although we'll caution that we still have more than $4.5 billion in unfunded liabilities that remain in the state plan. However, we expect to be about 90% funded by 2030. A similar trajectory here for the teacher plan. As of June 30th, 2025, the teacher plan's funded status was about 85.5% on a market value basis. And same here, about 90% funded we expect to occur by 2030, assuming that all of our assumptions are met. Based on our current outlook, both plans are projected to reach full funding or 100% funded by about 2043. So looking at our other VRS administered plans, you'll see that the judicial plan is about 88% funded. The Valors or Virginia Law Officers plan is 75%, and the State Police Officers plan is about 74%. It's also important to consider the other post-employment benefits plans, or OPEBs. Progress has been made on these plans. For example, the group life insurance program is now about 75% funded. But of concern is the health insurance credit benefit for the state, which is only 41% funded, and teacher plan, which is 26% funded. And they're less well-funded in part because they started pre-funding later than the pension plans. They were pay-as-you-go for a longer period of time. There were premium holidays with the OPEB plans, and there have been some benefit expansions without the benefit of pre-funding. But I'll focus now on the health insurance credit for the state plan because we welcomed the great news that of your recent appropriation of $93.6, almost $94 million this year, which will go in during fiscal year 27 to help improve the health insurance credit for the state. This will serve to reduce the liabilities. It was about 15% of total unfunded liability will be infused into that plan. And this is a great example of improving the health of the plans by lowering those plan liabilities as resources became available. And we estimate that if investment earnings are met during fiscal year 2027, getting about 675 in 27, the infusion will help improve the funded status of that plan on a market value basis by about 9%, or it could be about 60% funded. So that's a great news story for the health insurance credit. So I'm often asked how Virginia compares to other states with respect to our funded status. The blue bars are the funded status of various state plans. The yellow bar is VRS. We are in the top quartile of state public plans. The green line across is the long-term assumed rate of return, and you've heard Andrew speak about our 6.75 long-term assumed rate of return. Other states use different long-term assumed rates of return, and why that's important is that if you normalized or used 6.75 for everyone across various states, VRS would move up in these rankings. In fact, only 3 of the states with a higher funded status use the same or a lower discount rate than VRS. The code requires VRS to regularly report the results of our stress testing and sensitivity analyses to the General Assembly. And we recently completed this analysis, which highlights how the fund could be impacted if actual experience varies from assumptions. We primarily focus on assessing our financial resilience against potentially adverse economic conditions and downside risk. And we believe these robust analyses not only transparently model potential impacts of various scenarios, but also serve as a resource for the Board of Trustees, VRS staff, stakeholders, as well as staff at the money committees and the administration to provide strategies and approaches that can strengthen and improve the plans over time. So as I've shared previously, investment earnings currently fund almost 2/3 of retirement benefit payments. Not surprisingly, as Andrew mentioned, favorable market conditions over the past decade have served to help materially strengthen the health of the plan. But generating investment earnings can't happen without consistent funding. And so we're now seeing the benefits of the funding discipline that has been in place since essentially the great financial crisis, including full funding of the contribution rates and additional cash infusions into the plans. And these benefits are tangible, generating greater rate stability for our participating employers, reducing unfunded liabilities, improving the funded status for our plans, and greater resiliency, especially during periods of market volatility. So I'll pivot now and discuss how, as an agency, VRS is evolving to better serve members and employers, and I'll use the hybrid retirement plan as an example. Through targeted communications, we're helping employees better understand their options and increase their retirement savings. And we're seeing growth in voluntary contributions among hybrid retirement plan members, whether through active choice or this year's automatic escalation increase of 0.5%. There are some encouraging stats. About 94% of our hybrid retirement plan members are making voluntary contributions. So this demonstrates that these automatic features are working. Nearly 30%, or the beige part of that triangle, are making the maximum voluntary contribution of 4%. So outreach is making a difference in some cases. But about 38%, which is the light blue portion of that pie, remain at a minimum 0.5% level. And some of that is inertia, and some of it is the plan design. To generate a benefit for a hybrid retirement plan member that's similar to Plan 1 or Plan 2, they have to save more than the minimum. And so the bottom line is that it costs hybrid retirement plan members more than those in Plan 1 and Plan 2 to generate a similar benefit, and they must work a full career to do so. So education and outreach alone likely won't move the needle with respect to increasing voluntary contributions. But as Dr. Gooden noted, there are some enhanced automatic features that can make a meaningful difference, but legislation would be required. In addition to outreach and education and the hybrid retirement plan, the past year, we've expanded our enterprise data capabilities, we've enhanced our records management practices, we've explored responsible applications for use of AI, including developing an agency policy. We've modernized our human resource information system, which helps streamline our onboarding, hiring, performance management, and training. And we've also improved the accessibility of our digital content in advance of new federal and state requirements under the ADA. Again, you've seen lots of comparisons using CEM, but I wanted to share that VRS remains cost-effective in our service delivery as well. CEM benchmarking found that VRS delivers services at a significantly lower administrative cost than peer systems. Over the last 5 years, our average costs were 30% lower than peers while delivering similar services, even as pension system costs nationwide continue to increase. So in sum, VRS continues to provide cost-effective service delivery. Our plan funded status has improved overall, and employer contribution rates remain stable. With the support of the General Assembly and the Governor, including the recent cash infusion to the state health insurance credit plan, we've made steady progress toward reducing plan liabilities. And through your continued partnership, we can ensure that Virginia public employees retire with confidence and security. That concludes my prepared remarks, but I would be happy to answer any questions.
Thank you so much for the presentation. I have a question from Delegate Price.
Yes, thank you, Madam Chair. I think two of you now have mentioned the possibility of expanding, if I say it wrong, let me know, but like automations. And you said it would need legislation. Can you give us an idea of what some of those might be?
Sure. Thank you, Delegate Price. These relate to the automatic features in the defined contribution portion of the hybrid retirement plan. Currently, we have auto escalation, and so if you're not making the maximum contribution, every 3 years, we increase your contribution by 0.5% with the opportunity to opt out. So accelerating that, for example, could be one. You could do that every year instead of every 3 years. That's something that, with the employee's opportunity to opt out. For example, in Georgia, they auto-enroll their folks at their maximum. So for example, that would be auto-enrolling employees at the 4% max with an opportunity to opt out. They don't have a particularly high opt-out rate, but they also have a lower portion on their DB side of things. So we'd have to probably take a look at that. So those are some of the things that could be done. They would increase employer costs somewhat because instead of the match being applied to, for example, 0.5% of pay, it would be higher and more frequent increases. I hope that
I
helps.
believe Delegate Price has follow-up.
Yes, thank you for the follow-up with that then. Understanding that there could be the opportunity for opting out of both of those, would it not be worth it to have it as available to opt in, knowing that, like you said, it would increase employer costs, but do you know if that would not be as effective?
Sure. So actually, folks can now increase their rate whenever they wish
you would
on
be
a
making
monthly
it automatic,
basis.
so that's why you would
We
need to opt
also
out.
have a tool called Smart Step where they can set their predetermined when they want their increases to occur. So that's another way that they can do it. In general, automatic features where you have an opt-out tend to be more effective, in part because of inertia, right? All of us get busy and we just sort of forget to opt out, but then we don't necessarily realize that it happened. And so for some, particularly at smaller amounts, they may not recognize it because in your pay there are a variety of variables. But so automatic features tend to be more effective, but we do have a number of tools now where folks can make those changes on their own if they wish. And we call that active control. And I don't have the number off the top of my head, but we have a number of our participants who have taken active control of their account and auto-escalated, or basically made the decision to do either the max or a higher level than what the automatic feature would do. And I can follow up with you on that for sure.
You have another question? Okay.
Yes, Madam Chair, my last question for now. I saw that the policies had been updated and it said for responsible applications for AI. I was wondering if you could dig a little bit more into that, knowing that I'm pretty sure we could all find different definitions of what responsible is. I just didn't know what some of those examples might be.
Sure. So we're one of the things that we focus on is security and making sure that anything that we're doing is in a container that is just managed by VRS, not in public. But also there are things that are just kind of changing manual processes that we do now. So for example, in investments, some of their capital calls and distributions are now using AI tool to generate some of those manual processes, but with always having human oversight. of that. On our side, we're using it for some of the data review. We hold a lot of data. People will be with us for a 40-year career, and then we can pay them for 30 more. So if you think about all of that data, so we're helping to help our data scientists on our team be more effective in looking at those and trying to put in some queries that will help our team manage the benefits that we provide. So we are starting slowly. We like to not be on the bleeding edge of these kinds of things. There are things that are, and also on the coding side of things, we're looking at where potentially we might be able to use some of those tools to do coding with oversight of in our development shops. I hope that helps.
Any additional questions? If not, thank you.
Thank you.
Thank you, Madam Chair. And Delegate Price, I just wanted to mention, JLARC did a review of the hybrid plan last year, and we presented it to the commission in December. And so all of the existing members heard that, but we are happy to send all the new members it because it kind of provides some really good baseline information and kind of covers some of the potential opportunities that Trish mentioned, with some cost information. So we'll certainly send that to you and the other new members. Madam Chair, we will now turn to the Commonwealth Savers portion of the meeting. First, Alex Jansen, JLARC's Principal Analyst for Ongoing Oversight, will present our biannual report on Commonwealth Savers. While we report to you twice each year on VRS, we are only required to report on Commonwealth Savers every other year. This is Alex's first time presenting on Commonwealth Savers. She just joined the JLARC staff a couple years ago, so I will also be here at the table to help answer any questions if needed. And then following Alex, Commonwealth Savers CEO and Investment Director will present you with their annual update. Alex?
Good morning, Madam Chair, members of the Commission. As Kimberly mentioned, I am Alex Jansen, and I will present our biennial oversight report for Commonwealth Savers. Since I am still fairly new in this area, I may defer to Kimberly for some questions or additional context. This slide shows our mandate for ongoing oversight of Commonwealth Savers, which requires JLARC's oversight regarding the structure and governance, administration and management of Commonwealth Savers, as well as the structure of the investment portfolio and investment practices, policies, and performance. We also conduct a quadrennial actuarial audit here, and we presented that to the Commission last year. We submit this report to you, as Kimberly mentioned, every 2 years, and the topics that I will cover are listed on this slide. And I'm just going to start with some brief background information. So State 529 plans are tax advantage savings programs for education as well as individuals with a disability. They can cover costs associated with qualifying educational expenses such as tuition, books, room and board, tuition for private and religious elementary and secondary education, and student loan repayments. Commonwealth Savers also administers a state-sponsored retirement plan, which is authorized by state statute. So Commonwealth Savers administers 5 savings programs, and those include 2 defined benefit education programs, 2 defined contribution programs, and a retirement savings program. The agency also sponsors 2 national advisor-sold savings programs, including the National College America program. As I mentioned, Commonwealth Savers has 2 defined benefit college savings programs. One is the Legacy Prepaid Program, which was closed to new participants in 2019, but continues to pay benefits to contract holders. And then the second program is Tuition Track Portfolio, or TTP, which opened in 2021, and unlike the Legacy program, pays the same weighted average tuition benefit regardless of where the student goes to college. These assets are pooled in one account, the DB 529 Fund. And as of last year, the DB 529 Fund had an actuarial surplus of approximately $1.5 billion and a funded status of 232%, which translates to a more than 99% probability that the fund will have enough assets to meet all obligations. Commonwealth Savers has developed a framework to help assess how much can be drawn from those surplus funds for higher education access and affordability programs. The actual amount that could be allocated based on the framework depends on what assumptions Commonwealth Savers uses. And JLARC has been monitoring the framework to ensure it does not understate available funds. Switching now to talk about access and affordability programs. At the May meeting, there was a request to go over some highlights from the 2022 JLARC study of the DB 529 surplus funds. I will quickly go through a few key points before talking about the current status of those surplus funds. So the 2022 report found that there was well over $1 billion available to be allocated over several years and provided multiple options for how those surplus funds could be expended, through refunds to the legacy prepaid account holders and through access and affordability programs to help students get and stay in higher education programs. Some examples are listed on the slide. JLARC recommended that a dedicated fund be created to provide flexibility and a long-term funding source for access and affordability programs, similar to an endowment model, and also recommended that SCHEV should have responsibility to allocate funding from the dedicated source to programs fitting guidelines authorized in statute. Commonwealth Savers could retain the assets and management of the dedicated funds in the DB 529 fund. Following the 2022 report, Commonwealth Savers Board allocated $500 million in fiscal year 23. With an additional allocation at the recent June 25th meeting, the balance allocated for access and affordability programs is now approximately $1 billion, including investment returns on the initial allocation. After this allocation, the DB 529 fund still has over $2 billion, and so we believe substantial additional surplus funds could be allocated over time. Commonwealth Savers has not spent any of these funds because they have not been given spending authority. And to reiterate, JLARC's 2022 report recommended that SCHEV be responsible for allocating funds to programs. The General Assembly has made efforts to direct the use of the surplus funds over the past few years. In the interest of time, I will only mention these briefly. In the 2025 session, there were 4 bills that to various extents were consistent with the 2022 JLARC report, but would have had elements to provide scholarships, support access and affordability programs, and provide refunds to account holders. In the 2026 session, there were 2 bills that would have taken some surplus funds to provide scholarships, but across both of these sessions, none of these efforts were enacted. There was language in the 2025 Appropriation Act for a joint subcommittee to determine how to use the surplus funds, but it did not end up meeting. I've been talking to you about the surplus funds, which the General Assembly has not given authority to use yet. However, in recent years, Commonwealth Savers has taken steps to support access and affordability programs using their operating funds. Going back to fiscal year 21 and 22, Commonwealth Savers used a budget execution adjustment, or BEX, which is an administrative process approved by DPB, to fund 6 partnership programs, which were funded through fiscal year 25. At the end of fiscal year 25, just before June 30th, Commonwealth Savers used a BEX for $25 million to continue funding those 6 partnerships and 3 new ones. In the 2025 Appropriation Act, there was language that expressly prohibited Commonwealth Savers from committing additional funds after July 1st, 2025 for access and affordability programs because the General Assembly has expressed that they want to weigh in on that spending. And I can pause here for questions.
Any questions at this point? Senator McDougal.
Going back to slide 8, on the tuition track portfolio, what is the weighted average tuition and how many public institutions in Virginia fall above that and how many fall below it?
Thank you for the question, Senator. So I will say the weighted average tuition is based on forecasted tuition at public universities. And so there is a formula that goes along with that, and I will defer to the experts from Commonwealth Savers to specifically tell you what exactly that formula is, and I can follow up with you as well. Since it is the average, I would imagine about half are above and below. I got a nod from that.
Madam Chairman, I'd love to see a list of the half that are above and half that are below. And if it's half, the number of public institutions, or if that half is based on the number of individuals enrolled at public institutions in Virginia.
Absolutely. Thank you. We can follow up with that. Or Kimberly has context.
Senator McDougal, yes, we will definitely get you that if Commonwealth Savers doesn't have it already, but it's weighted average tuition, so it's based on enrollment, like you said. So, but we have that information.
Okay. All right. back to my slide. Thank you. I will now talk about Commonwealth Savers Education Savings Programs. First, I'm going to talk about the defined benefit programs, so legacy prepaid and TTP. The surplus we've been talking about largely comes from those programs. I'm going to talk briefly about the participation and a program update, and then move to the performance. So total liabilities for the two defined benefit programs have declined considerably in recent years, and there are several contributing factors. First, the legacy prepaid program has been closed to new participants for about 7 years, and the number of open accounts is decreasing. Second, there was a period of about 2 years between the legacy program closing and TTP's opening when no additional liabilities were taken on. And finally, TTP units are not selling at the same pace as historical legacy semesters did. Speaking of the TTP program, as part of a 2018 JLARC report, we recommended that Commonwealth Savers assess the program after its implementation. Commonwealth Savers has released the report from their assessment and state that TTP has performed as expected. It is growing faster than similar programs in other states. However, Commonwealth Savers acknowledges that TTP accounts have been purchased at a slower rate than legacy prepaid accounts. One obstacle to the program's growth is that Commonwealth Savers has not explained the program in a way consumers understand. In focus groups conducted by Commonwealth Savers, potential or new participants struggled with the concepts of the program's units, and meanwhile, existing participants weren't sure if they were on track with their savings. Commonwealth Savers plans to enhance their marketing and communications efforts to increase understanding by moving away from units to dollar-based messaging, small video explanations, and targeted outreach to different groups. Switching now to performance for the DB 529 fund, and the reason performance matters is it impacts the amount of surplus funds that are available, and we want to get the best return on the Commonwealth's money as well. You can see that the total fund underperformed in all periods. A major driver of that is the private equity asset class. The private equity benchmark is difficult to beat since it is set at the public equity performance plus 300 basis points. And as you heard in the VRS update, it's been difficult for private equity to keep pace with the strong public markets. However, Commonwealth Savers is still exceeding the long-term return assumption of 6% in all periods except for the 5-year period. We've been talking about the defined benefit programs, but I'm now going to switch to Commonwealth Savers defined contribution programs, which are more like traditional investment accounts. Invest 529 is sold directly by Commonwealth Savers, and that program has continued to grow, seeing a 9% account growth per year and more than a 13% asset growth per year over the past 10 years. College America is a national advisor sold program. It is the largest 529 program in the country, accounting for more than 20% of the industry, and the number of accounts and assets there have continued to grow. The Invest 529 program, which is primarily Virginia account holders, met or exceeded benchmarks for a majority of options across all time periods. In the shorter time frames, a majority of College America's options did not meet their benchmarks, but given the longer-term focus of accounts, the good news is that a majority of options met or exceeded the benchmarks in the longer time frames. And I just want to reiterate that most of the College America accounts are not Virginia residents. And I will now talk briefly about Commonwealth Savers disability savings programs. Similar to the defined contribution education programs, Commonwealth Savers has a direct sold program, Able Now, and an advisor sold program, Able America. These programs have continued to grow, and the majority of the investment options for both programs met or exceeded their benchmarks in all periods. And I will turn finally to the state-sponsored retirement program. The purpose of this program is to provide a retirement option to private sector employees who don't already have access to a retirement plan through their employer. All eligible employers are required to participate if not already offering a retirement program. Employees, if they do not opt out, are auto-enrolled at a 5% contribution rate that escalates annually to a maximum of 10%. Since RetirePath was launched in 2023, accounts and assets have grown rapidly, and the investment options are all meeting or exceeding their benchmarks for available timeframes. And RetirePath has now expanded. The General Assembly passed that earlier this year, so now employers with 5 or more employees are required to participate if they don't already offer a retirement program. Employees may still choose to opt out, but the expansion is estimated to reach an additional 357,000 eligible employees. Because of the large scale of the expansion, Commonwealth Savers plans to onboard employers in 2 waves by this coming fall, first targeting employers with 10 to 24 employees, and then employers with 5 to 9 employees later in the summer. There are some additional initiatives from the federal level that will go into effect this coming January 1st that may affect RetirePath. The first is the Savers Match Program, which provides eligible savers with a 50% match for their contributions up to $1,000. And Commonwealth Savers is working on how to integrate this into RetirePath. The second initiative is the expected launch of TrumpIRA.gov, which will allow individuals to open an IRA with investment options similar to the federal thrift savings plan. This is not intended to replace state-run retirement programs like RetirePath, and one aspect that may influence the scale of impact is that RetirePath is auto-enrolled, while individuals must actively sign up at TrumpIRA.gov. And Madam Chair, that concludes my presentation, but I'm happy to answer any questions.
I believe Delegate Rasul has a question.
Yes, thank you, Madam Chair. Good morning. Thank you for that great presentation. Welcome to the position. As asking a selfish question, I have 3 children who are in the next several years are going to be going into college. We used to love the branding around the prepaid track. Like I pay in and I understand probably we ventured away from that because maybe it was unpredictable or maybe there was such a high increase in the cost of higher education. But, it seems to me like with the great surplus that maybe we have, that we could be, I know this is a tired question that you all probably talk about very frequently, thinking back to, instead of trying to rebrand this a million different ways, why can't we maybe go back to this prepaid thought and maybe use some of that surplus for a prepaid track again? I just think it's very easy to market, and that I think parents love it. Speaking as just a selfish parent, thank you.
Thank you. For that, I will defer to Kimberly. When that study was done, it was just before my time here, so.
Sure, that's it. I don't know if this mic is working, but that's an excellent question, Delegate Rasul. And there were a couple of reasons why Commonwealth Savers switched to the tuition track portfolio. And actually, JLARC did a study around before they switched. The commission asked us to do a study, and we found that the switch did make sense for a couple of reasons. One, as you mentioned, the contracts were getting very expensive. People had to buy semester contracts. The other thing is there was a little bit of a fairness issue. So people would purchase these contracts. Everyone was paying the same for the contracts, essentially, but then the payout really depended on where the child went to college or the student went to college. So if you went to William and Mary, you would get a much higher payout than if you went to one of the state's cheaper colleges. And then if you went to a private school, or if you went to out of state, you would really take a hit. And so the idea behind tuition track portfolio, and several other states have transitioned to these types of plans, is that people can buy smaller units, so it's a little bit more affordable, but also you get the same payout. Everybody gets weighted average tuition. So if you go to a college if your student goes to a college that's cheaper, they can use some of that additional maybe money they might have, additional savings they would have for like books or room and board. If they go to one of the more expensive colleges, they may have to pay more themselves. But the idea is it really makes it a lot more equitable so that you're not penalized for where you're going, so to speak. So that's kind of, but to your point, people are confused, and that's a problem. And so I think that Commonwealth Savers, they've been working on it. They need to continue to market in a way that's intuitive so people understand what they're getting and how close they are to getting to their college saving goals, if that makes sense.
Yeah, thank you. I think in meetings with the staff, they've done an excellent job of explaining some of that inequity. And when we go to the payout model, I think that there's probably still something there, even if it's a tiered approach, which I think that you were trying to get to with the units. Like you buy in at this, and there are certain tiers based upon tuition levels of the costs of certain institutions. But I just think it's just very easy to consume. So, but good luck in trying to figure it out, and we'll just keep saving. I have 3 529 accounts, Commonwealth Saver accounts, so we'll just keep putting money in. Thank you.
Any other questions? No? Okay, thank you. Oh, I'm sorry. Delegate Price.
Yes, thank you. When you were going over, I think it was slide 15, but some of the slides that went over, yep, so sorry, not that one at all. But it was going back over the 2022 JLARC report, which had legislative recommendations. And then you talked about some of the things that we have done. Is there a way for us to get an updated view of some of the 2022 recommendations, knowing that some might not work anymore because something might have changed, but just I would be interested to see what of the recommendations we've left on the table that would still be relevant or helpful moving forward.
Thank you, Delegate. I think that's a really great question, and I think we can follow up with you on that.
Yes, and I can give you a high-level response right now, which is really all of the recommendations are still relevant. The only thing that's changed is the surplus has continued to grow. But all of the recommendations are still relevant. The one I will say, the one nuance is in the legislation that was introduced this past year. It took a little different approach in terms of how to determine how much surplus funds could be available. That report recommended an independent like advisory committee. The approach taken in that legislation, which we thought was reasonable, was that the board would recommend the amounts of surplus fund that could be available, and then JLARC, the two pieces of legislation had JLARC doing kind of an independent assessment every 2 years, again, to be an objective view that, that the General Assembly's intent would be followed. But in short, that the recommendations in that report still stand.
Additional questions? Okay, thank you.
Thank you, and I'll now introduce Mary Morris, the Chief Executive Officer of Commonwealth Savers, who will be followed by Michael Swink, the Commonwealth Savers Investment Director, for their annual update.
Good morning, Madam Chair, members of the Commission. Thank you for the opportunity to spend time this morning discussing the programs and activities of Commonwealth Savers. If I may, I'm going to jump to the two questions because I think they're related before I jump into my prepared remarks. Senator McDougall, there are 7 universities that are above weighted average tuition, 8 that are below. Most fall pretty close to that center line. There are only 3 that are substantially above weighted average tuition, and 2 of them are some of our smaller universities. So William & Mary, UVA, and VMI are substantially above. The others are moderately above. The range of cost is from $10,400 to $26,400 for tuition and fees at our universities, and so that was part of the rationale for changing the prepaid program 7 years ago. Really, we started the discussion before that. The weighted average for this last academic year was $16,000. That's a bit of a rounding for us, but $16,000. We expect it to go up slightly, 3 to 4% this year. That basically goes with tuition inflation. So exactly, now with the tuition track portfolio, payouts, regardless, you pay in at the unit value, you can put a very small amount in, or you can prepay up to 1,000 units, and you can cover more than just tuition and fees. A tuition track portfolio can be used for any of your qualified higher education expenses, whether you go in-state, out-of-state, public, or private. The payout's the same, so it is simpler. It is people know what value that they have, and you don't have that disparity in what people are paying in and what they're getting paid out over time. I'm a William & Mary alum. I always said you sort of hit the jackpot if you go to William & Mary with a prepaid contract, and some of the other schools was less so. So we did think about that a lot. I will say also, we just had a conference recently, and prepaid programs, those that are left around the country, similar to ours, and we found the same thing with prepaid. In times of very strong market performance, which we've had for the last 15 or so years, and moderating tuition inflation, which is largely thanks to the work that you all have done and our universities. That's been moderating for the last 7 or 8 years. Prepaid contracts don't seem as popular. And so our prepaid enrollments lagged a little bit back then. Every state that still has a prepaid program, they are finding for the last several years that account uptake is slower. People are going into the defined contribution plans. They think they can do better in the markets. They have been so far. Someday that's likely to change, or if tuition increases start to go up, they tend to come back to those defined benefit programs. And we did struggle. And I will say also, we are not yet back up to what we had to price a prepaid contract at when we closed in 2019 because of that impact of the more expensive schools. So overall, it becomes a more effective and more cost-effective, so we think more participants can participate, and we are continuing to work. I've got a slide later on in my presentation that goes over some of the things we do to help educate folks about the benefits of a defined benefit program. But I'll start here with telling you that 2026 is an important year in our history as we celebrate 30 years from the passage of IRC Section 529 and the opening of the Legacy Prepaid Program, which predated Section 529. As you see from our changing logos, we've evolved into a complex and mature organization with multiple statutory mandates. After a summary overview of our programs, I'm going to cover the highlights of the past year for each and what's on the horizon. This snapshot of programs provides a sense of the breadth and scope of the agency. Our oldest mandate and the largest program is in education savings, with almost $125 billion in assets under management as of March 31st, after 30 years of steady growth. Our disability savings mandates came more than a decade ago with passage of the federal Achieving a Better Life Experience, or ABLE Act, and Virginia's rapid support with legislation in 2015 directing Commonwealth Savers to create an ABLE program. Most recently, as part of a growing trend across the country, in 2021, you directed Commonwealth Savers to create a state-facilitated private retirement program. Our ABLE and retirement programs also are experiencing significant and steady growth. More than 15 years ago, we opened the SOAR Virginia program after receiving your statutory mandate to develop and implement education access and affordability programs that might reach all Virginians. Virginia is a force in the ongoing development and expansion of access to programs that advance and enhance financial health and wellness for our citizens and make their dreams and goals more affordable and attainable. Engagement and advocacy on the national stage is required to keep moving forward, and recent federal changes to both 529 and ABLE program eligibility and flexibility, which I'll discuss in a few minutes, reflect the thought leadership and work of our team. Although the numbers are impressive, the impact of Commonwealth Savers is best seen through our customers and the millions of people improving their personal financial situations through the programs you have supported and made possible over the last 30 years. Program participants best express the why of Commonwealth Savers, and the following very short video gives insight into the impact made possible by your support of our work. And that didn't do what it was supposed to. You're going to do it. Okay. Thank you.
The best thing I did for my children was to ensure that they graduated college debt-free. And that was because of the 529 plan. I learned very early the value and the potential of having a savings plan in place for my children, and that thought proved extremely beneficial.
As a nonprofit, there are typically not benefits that go along with that. People do this work because they love this work. It's hard, but it's heartwarming and filling at the end of the day. And so when I read about Retire Path and then I made some phone calls, I went, this is absolutely the best thing to do for our people here. And so for those who have never had an opportunity to have a retirement plan, it gives them that opportunity.
Saving with ABLE now helps me to have a nest egg as well, so I can fall back on my finances should I have any hurdles in my future.
I truly don't think that I would have gotten as much support, known about as much scholarships, gotten the aid that I did if I didn't have her and SOAR and the GRASP community there to tell me what to do. I really had no idea before.
Thank you. Oop. That went too fast. Each of our programs and mandates has a distinctive brand and name, with Commonwealth Savers as the unifying theme. I start this morning with ABLE Disability Savings Programs. ABLE Now, which opened in 2016, and ABLE America opened in 2019 with the support of our education savings partner, Capital Research Group, and the American Funds Mutual Fund family. The two programs provide options suited for the unique financial needs of individuals and families living with a disability. ABLE Now assists with saving options to grow assets and options to pay for ongoing expenses conveniently while tracking assets, helping individuals seeking to enhance their independence and improve their quality of life by gaining control of their finances. ABLE America is most powerful for long-term investors who do not plan to use the accounts for ongoing daily expenses, but look to meeting future needs. The Able Age Adjustment Act passed 3 years ago with a delayed implementation date of January 1, 2026. That immediately doubled the number of eligible disabled Americans by expanding the age of disability onset from 26 to 46 years. The prior restriction excluded the millions of Americans who experience an event or medical condition as young adults, a high percentage of whom are in the armed forces and are first responders. ABLE Now has seen an increase in new accounts already, even as we managed through a successful program record keeper transition during the first quarter of 2026. We transitioned to a new platform that provides an enhanced customer experience with reduced fees, a modernized management platform, and a new gifting tool to make it easier for friends and family to contribute to ABLE Now accounts. In the first 2 months post-conversion, more than 3,000 new accounts were opened. That is historically very strong growth. Enhancements to entity enrollment will further strengthen the program and benefit an ever-growing number of participants. I'll move next to our newest program, Retire Path Virginia, an auto-enrollment IRA plan for Virginia workers with no retirement option available through their employer. Recognizing that almost 50% of working Virginians were without access to workplace retirement savings, that there is strong linkage to participation through the workplace and to the economic benefits the Commonwealth will reap through higher retirement savings participation, the General Assembly in 2021 directed Commonwealth Savers to create and implement a state-facilitated workplace retirement savings program. The result is Retire Path Virginia, which opened just 3 years ago and quickly enrolled more than 25,000 Virginia workers who have already saved more than $30 million for retirement. Retire Path covers industries and workers often left out of financial wealth building programs, with higher numbers of women, minorities, and younger workers with more modest wages. The benefits of retirement savings, combined with the financial education opportunities provided to Retire Path participants, will be life-changing. Retire Path began with a threshold for employers with 25 or more full-time employees, excluding almost half of Virginia workers without a workplace retirement solution, because for many valid reasons, smaller employers are most likely to not provide that benefit. This year, you and your colleagues in the General Assembly supported the expansion of Retire Path to hundreds of thousands of Virginians, and for that, we thank each of you. Thanks go in particular to Senator McPike and Chair Torian, who carried the legislation. But you all share in the success because those bills received unanimous support in both houses. So again, I say thank you. This was a big win for working Virginians. Retire Path has received tremendous support from participating employers around Virginia, and that paved the way for the expansion. What makes the program work is that it allows an employer to assist their employees with a workplace retirement option without the attendant costs and fiduciary responsibility that comes from an employer-sponsored plan. This is particularly important for newer and smaller businesses with small margins. Our team has started outreach to newly eligible employers already to begin the onboarding process. Although employers are required to participate if they don't offer another retirement savings option, Our focus remains on educating employers and employees about the program and its benefits, not on a negative, forced enforcement approach. We understand this is a process, and full awareness and adoption will take time. Remember also that employees always may opt out of participation, although we maintain an impressive stick rate of some 75 to 80% of enrolled employees. Additionally, as our programs and others like it across the country receive attention and stimulate interest in retirement savings, more employers are deciding to offer a 401k program to their employees and opt out of programs like RetirePath. That was hoped for and anticipated and provides a nice continuum of options for working Virginians. And RetirePath is fully portable. Moving next to education savings, the original reason for the creation of what is now Commonwealth Savers. The timeline shows a few milestones in our 30-year education savings history, from the opening of prepaid 529 to the expansion to defined contribution savings programs, such as the award-winning Invest 529 and College America. Today, across the more than 100 529 programs in the country, Commonwealth Savers customers represent more than 20% of accounts and assets. The strength of our education savings programs and stewardship is confirmed by the participation of customers and recommendations of financial advisors across the country. This is perhaps best seen in the steady, almost 25-year growth of the advisor-directed College America. Virginia and our citizens benefit in many ways from the size and scale of our programs, including enviable low fees and the ability to provide more education access and affordability services than any other state. Best seen in the initiatives of the SOAR Virginia program, launched in 2010 to provide services and reach students and families routinely left out of post-secondary education for lack of resources and knowledge about what is possible. The sidebar highlights ways 529 accounts have continued to grow and evolve, making them more flexible and therefore more attractive programs for families. The growing need for more education options, including workforce training and specialized credentialed education opportunities, is a trend Commonwealth Savers has embraced, and as with other legislative improvements, the Virginia team was instrumental in the recent expansion of 529 account coverage to many more credential, certificate, and continuing education programs. I could spend all our time talking about the ways we assist customers and reach new participants, but I won't. As with all aspects of our programming, we are happy to meet with any of you individually to follow up on specific questions or inquiries, however. Much of what Commonwealth Savers does is related to education broadly, with a focus on financial education and expanding the recognition by everyone of the importance of education at all stages of life. There's no one correct educational path, and our outreach and education tap into that theme. Here you see some information on the online portfolio selection tool we've created to help families navigate their Invest 529 savings options, including the tuition track portfolio, and assess their needs and comfort with a variety of options. Participants may select among options that suit virtually all needs and goals, regardless of their risk tolerance or savings time horizon, without being overwhelmed by their choices. The tuition track portfolio deserves separate discussion as the successor to the legacy prepaid 529 program. It provides a unique opportunity to Virginia families to keep pace with tuition inflation. The tuition track portfolio is less expensive. It is a simpler and more flexible tool than the original prepaid tuition contracts. As JLARC staff noted in their report, we do continue to refine our messaging and outreach to ensure Virginians are aware of the option and exactly what it offers, including no administrative fees and no market risk. And you can see we have sliders, we have webinars, we have a written guide, we have a performance overview, on-demand sessions, and tuition track calculators. So it is, in some ways, a more complicated message. We've tried to take that out of it and make it a little bit more like a regular option within the Invest 529 program, but pointing out that it does give that certainty. So we do still have a defined benefit program. It just looks and feels a little bit different. And I do believe that the interest in it will take an uptick when, and not if, there's a market correction or increasing market volatility and/or tuition inflation increases. On the education access front, a single slide shows the breadth and scope of the current SOAR Virginia program, which has been funded with net operating revenues from our non-general fund sources, which in 2025 served more than 70,000 students across all of Virginia. We're focused on access, affordability, and attainment. SOAR Virginia depends on partners and initiatives aligned with those pillars for the implementation. Access programs rely on early outreach and interventions to ensure students are on a pathway to education attainment. The focus then shifts to how to pay for post-secondary education, using 529 accounts, of course. Really, everything we do is about education access and affordability. FAFSA completion and financial aid, and general financial education. Leading students to the doors of post-secondary education, however, isn't enough. The key is attainment or completion, career exploration, transition services, wraparound support for students while in college, particularly community colleges, and opportunities to earn workforce credentials and internships are some ways to enhance retention. Measurable outcomes and evaluation to ensure supported programs are effective and achieving desired results are keys to the strength of SOAR Virginia's programming. All of that leads to the discussion that you may have been waiting for this morning, the status of the Defined Benefit 529 Fund and the Access Fund created by the Commonwealth Savers Board in 2023. The DB 529 and Access Funds are two sub-funds of the Special Non-Reverting Enterprise Fund of Commonwealth Savers. As the staff report you heard earlier noted, and you are aware after years of ongoing discussions, the DB 529 Fund has a substantial actuarial surplus, which provides an opportunity to do more than just cover the contractual obligations, which was and remains its primary purpose and reason for existence. The surplus is the result of a combination of factors which we have covered before, including careful stewardship and investment management, decreasing liabilities, prior allocations of net non-general fund revenues to the fund, and moderating tuition inflation. The Commonwealth Savers Board has continued to do its job as trustee in addressing the surplus as the General Assembly has considered its options. You have heard before about the risk metrics the board adopted, actions related to trust fund investment management, and proposed access and affordability options. All parties are aligned on the unique opportunity presented with the need only to gain consensus on execution of a plan. In 2023, you'll see the Commonwealth Savers Board authorize creation of the Access Fund with an initial allocation of $500 million. As of March 31, that had grown to $617.5 million. Just last week, the board, at its regularly scheduled meeting, considered an additional allocation to the Access Fund based on a review of its comprehensive risk model, thresholds, and scorecard. Based on all the positives in that review, including an escalating funded status, they authorized an additional Access Fund allocation of $375 million, with another $175 million approved for December 2026 if all risk parameters remain positive until then. This action reflects the board's commitment to continuous monitoring of the health and status of the funds and to prudently and safely managing these trust funds to maximize the opportunities presented by the actuarial surplus while ensuring the safety and liquidity of the funds to meet ongoing contractual obligations. The DB 529 and Access Funds are commingled for investment purposes, and the Access Fund assets may not be spent, as you heard earlier, without further action by the General Assembly. Commonwealth Savers continues to work with members of the General Assembly, JLARC staff, and Money Committee staff, as we have over the last 6 years, to develop consensus about the management and how expenditure decisions will be made. We believe much progress has been made and look forward to continuing to work with you all in the coming months to finalize a plan in the 2027 session. With that, unless you have questions for me, I turn the floor over to Investment Director Mike Swink to discuss the investment management of the assets of all Commonwealth Savers programs. Because as you know, whether we're making the day-to-day investment management decisions or working with partners like Capital Group, the ultimate fiduciary responsibility for all Commonwealth Savers programs and the interests of our participants and the Commonwealth rests with our board and management team. Thank you.
Thank you. Are there any questions before we go to the next presenter?
And I'll be around if you have any. Mike?
All right,
Oh,
thank
there he
you.
is. Grab my water.
Thank you, Mary. Thank you, Madam Chair, and members of the commission for the opportunity to present. You've heard about markets today already from the VRS, so I won't rehash everything. Markets are up year to date, which is, of course, a positive. While that's the case, it's been a volatile 2026, primarily driven by uncertainty around the conflict in Iran, concentrations in markets relating to AI, as well as the trajectory of monetary policy. On this chart, the lines show various equity and fixed income indices. A note on the volatility, the NASDAQ, for example, which is the blue line, was down 11% year to date at the end of March lows. That's only to be up 16% year to date through 5/31. So big moves. These are big moves and are somewhat hard to see even on this chart due to the scale that we needed to show the substantial move in crude oil. Crude oil is the yellow line, and at points was up over 100% due to the ability of ships to pass through the Strait of Hormuz. The pink shade on the right axis shows the volatility index, which spiked into the 30s around the dislocation in March. 50s as a reference point were last year's highs during tariff-related volatility, and a typical number is around 20 or below. On monetary policy, just for a sense, beginning of the year, markets were pricing in further rate cuts. Now, with increased inflation, largely due to energy prices, expectation is actually for a raise in 2026. While markets remain strong, there are reasons for optimism and reasons for potential concern. DB 529 is set up to achieve objectives in various market environments. DB 529 is the asset pool that backs obligations under the legacy prepaid tuition program as well as the tuition track portfolio. Primary asset management goals of this program are to meet long-term liabilities and exceed a benchmark over a long period of time. The pool contains a mix of fixed income, private real estate, private equity, and public equity, and it's designed with a goal of meeting or exceeding 6%, the current actuarial return assumption, over a long term with an acceptable amount of risk. On that theme of risk, as a defined benefit plan, there are lots of similarities and differences to a pension fund. A key differentiator is future funding. Cash flows into this plan occur only from product sales, and there's no ability to go back to customers and attain additional funding if we get that wrong. I point this out just to emphasize how critical sound risk management is for us. To tie the portfolio construction back to market volatility, would call out a few of the asset classes used as building blocks. Core fixed income, for example, 20% of the fund is in high-quality bonds that should hold up during a downturn. This segment of the portfolio could support around 4 years of program payouts if a substantial market fallout were to occur. That would buy ample time to not sell higher risk assets at depressed prices. The other side of the spectrum is the equities. We have a mix of global equities that would be expected to put up strong returns in a risk-on environment. The private markets investments are able to be used due to the long-term nature of the liability. The strategy here is to give up unneeded liquidity for potential excess return. Over time, that has been successful. Moving on to how asset allocation has translated to results. The box on the right shows the net of fees returned since inception, as well as the benchmark for the same time period. It also shows the current actuarial return assumption for the program. At 6.37% annualized over the program's existence, all long-term objectives have been met. We've exceeded the benchmark, exceeded the current actuarial return assumption, and also it's exceeded realized tuition inflation over that same historical period. With a portfolio subject to market that includes risk and interest rate sensitive assets, short-term results will of course vary. You saw a similar chart actually from the VRS on this. Point out the GFC, for example, we're down 16.3%. 2021, the flip of that, up 23.6%. But finally, I want to call out the fiscal 2026 year-to-date return of 10.03% through May. June numbers are not final yet, but we don't expect they will materially impact this figure. This return is notably higher than the actuarial return assumption for the fiscal year ending, which will support the health of metrics like funded status. While that, of course, is a positive, we don't focus on that too heavily given the short time frame. Moving on, Invest 529 is our $13 billion direct sold 529 savings program. This program is managed in-house versus an outsourced record keeper or fund provider. As such, we have a custom target date fund glide path that we construct versus an off-the-shelf product. Morningstar rates this plan and consistently gives it high marks. Currently, it's one of their medalist-earning funds. This chart shows the performance of those target date funds, which has been strong in the short and long term, both from an absolute and benchmark relative perspective. Portfolios start around 86% equity and migrate down in risk to 100% stable value once the beneficiary is college age. A combination of active and passive management is utilized in this series. We are very cognizant of the tail end of the glide path given potential negative impact of a drawdown prior to needing the funds, as funds are typically spent down over 4 years, which of course corresponds to college. 40% of program assets are in the target date fund, so we wanted to call that out. Much of the rest of the program is in passive options, which are achieving their objectives of tracking a benchmark. Fees are important to us in this program and are very competitive. We've actually historically compared this to a scatter plot that Morningstar puts together of fees, where one axis has the amount of active management and the other axis has fees. On that exhibit, there's actually no plan that has lower fees for the level of active management utilized than Invest 529. I wanted to also cover briefly the performance of our other programs, College America, Retire Path, Able Now, and Able America. These programs have a program manager versus the internal management record keeping of DB 529 and Invest 529. From an investment perspective, that translates to selecting a lineup versus managing all aspects of the investment offerings. College America is an advisor-sold program that has over 40 portfolio options. Excuse me. This slide shows the target date funds, but there are also many individual and balanced fund options available. Given it's an advisor-sold program, we offer the full suite of capital groups investment options with the exception of anything tax exempt. This allows advisors maximum flexibility when working with their clients. The program has been successful in meeting objectives, and like all of our programs, this one is available nationally. I think someone mentioned earlier, 90% of these accounts are out of state, which is a testament to the strength and reputation of the program. Advisors around the country could be putting their clients into any state's program, and they are consistently selecting Virginia. Able Now. This is our direct sold disability savings program. These customers are much more transactional, generally speaking, versus looking for long-term investments, but there is a mix of both. The general strategy here is keeping a checking account option as well as a very straightforward mix of balanced funds as well as a savings account with a higher rate. We just changed record keepers for this program, and that allowed us to do a lot of things on the investment side that weren't supported under the legacy construct. I'll try to avoid getting into too much detail, but the high-level takeaway on this change is even better options at lower fees. We reconstructed the balanced fund options to obtain the same market exposures, but with substantially less asset management fees, 70% lower actually. We added a bank savings option that replicates what we have done in our Invest 529 program that leverages our relationship with Atlantic Union Bank to offer a very attractive rate of Fed funds plus 15 basis points. This replaces the legacy money market option and offers a better rate with lower fees. We also lowered our admin fees by half to 5 basis points from 10, and the program manager fees were lowered 33% to 10 basis points from 15. The all-in fees for these options all are more than 50% lower than the legacy construct. Substantial win for the customers. Able America, unless there's questions, I didn't intend to get into many of the details on this one. And finally, Retire Path. All index options in this program to keep fees down. Target date fund options for those investors that don't want to think about asset allocation. We also have an international equity option, a U.S. equity option, core bond option, and a money market option for those that want to do something outside of target date funds. Over time, contemplation can be given to additional investment options, but as a newer program, it's been best to keep it simple as we're onboarding relative newcomers to investing. An objective of the current lineup effectively is maintaining simplicity while providing the main building blocks an investor may need to put a portfolio together. All funds are meeting their objectives, which are tracking in an index, and for the target date funds, taking a measured approach to risk and return throughout the glide path. There are some appendix items would call out, and I would call out those relating to the structure of our investment program, which involves highly credentialed and experienced investment internal staff, and an investment advisory committee, and our investment consultant, which are the three pillars of our investment program. This concludes the prepared marks I had, but Mary and I are happy to take any questions the commission may have or can follow up directly with anyone, as no time may be short today. Again, I want to thank the commission for the opportunity to present.
Thank you for your presentation. Are there any questions with regard to the Commonwealth Savers Plan, what we've heard here today on this? Okay.
Thank you.
Thank you. She's late pushing a button. Delegate Price has
No,
a
my
question.
brain is slower than some, but it's fine. I did have a question for this one, much like what my colleague asked. Are there any parameters for investments in this area? Because I think the answer before was, greatest return, lowest risk, but there weren't any other kind of like guardrails on investments. Are there any for this one?
We have the same language in our investment policy around pecuniary risk and return as the primary objective.
Does that address your, oh, okay, all right. Any other questions? Okay, if not, thank you. Back to you, Hal.
Madam Chair, that completes our agenda for today. Our next meeting will be Tuesday, September the 8th, at which time we'll present to you the findings from our review of agricultural best practices cost share program. And thank you for your attention today.
Thank you very much, and thank you to our presenters for the updates today on VRS and the Commonwealth Savers Plan. And thank you to those members joining us virtually and those here in person. Thank you for being here today. And I'm so disappointed, Delegate Reed, you had not one question. So again, thank you all so very much.
I think that was truthful. He was down there talking. He was talking to you the whole time.
Yeah. Thank you all for being here.
Thank you.
Thank you for joining us. This concludes this broadcast of the Senate of Virginia in Richmond, Virginia.